The headline on these capital gains tax changes is that you'll pay more tax, and that's true. But if you own a business, the rate going up isn't the part that should worry you. The thing that decides what you actually pay when you sell is something else entirely, and it's worth understanding well before you get there. So let me walk you through it. First, what the change really is, because before budget night, I predicted the discount would get cut from 50% to 33%, and the government went further than that. The 50% discount where you only paid tax on half your gain, that's been scrapped from 1 July 2027. In its place, you get cost-based indexation, which means you adjust what you paid for the asset up in line with inflation before you work out the gain. So you're taxed on the real gain, not the paper one. Then on top of that, there's a 30% minimum. So no matter how low your income is in the year you sell, you can't pay less than 30% on a capital gain. And I want to point out that for most people, this 30% minimum is actually going to be 32% because you've got the 30% tax minimum, plus you've got the 2% Medicare levy, which only starts to cut out from below $30,000 of taxable income for the year. So if you've got a capital gain and you've got more than $30,000 of income for the year, then you're going to be paying at least 32%. And that bit, the government didn't tell you about in their budget, did they? And this bit is the part that is going to catch business owners off guard. Under the old rules, if you timed a sale for a year where you had no other income, you could get your effective tax rate down quite low. Now, there is a flaw underneath it. Even with no salary, that year, the minimum tax rate is 30 or 32%. To show you how hard that flaw is, picture someone fully retired living off a tax-free superannuation pension. So with little or no other income, they normally sit under the tax-free threshold and pay nothing. They make a modest capital gain, say a few $1,000s. Under the old rules, that gain would have been tax-free. Under the new flaw, they still get a tax bill on it purely because of the 30% minimum that overrides their low income. If it catches someone in that position, it'll catch you. A couple of quick things so nobody panics unnecessarily. This is all for assets you've held more than 12 months and your family home is untouched. The main residence exemption stays exactly as it is. So this isn't about the house you live in. And this isn't only about shares and property, because when you sell a business, the goodwill and the client base are a capital gain as well. So the sale of your business sits under these exact same rules. To see what that does for you, it helps to go back to the numbers I ran before the budget. In my pre-budget video, I showed the effective tax rates at different discount levels. And the short version is that on the top tax rate, the old 50% discount got you down to about a 24% tax on the gain. That was the number that made holding investments in your name worth it. The new system is more involved than a single rate. So let me actually walk you through it, because once you see it, the rest of this video will make sense. Say you bought an asset back in 2024 for $2,000 and you sell it in 2028 for $3,300, a total gain of $1,300. Most of that growth, $1,000 of it, happened before 1 July 2027, and only $300 came after. Because it straddles the cutoff, the gain gets split, and you've got two ways to work out the split. The first is the valuation method. You value the asset at 30 June 2027, which fixes the pre-cutoff gain at $1,000. And that part still gets the old 50% discount. So it halves the gain to $500. The $300 that grew after the cutoff goes under the indexation method. So we work out the cost base by taking the 2027 value of $3,000 and indexing it for inflation of, say, 3%. This gives us a cost base of $3,090. Against the sale of $3,300, we have a gain for the post 2027 part of $210. Add those two together and your taxable gain is $710. So on the top rate, the tax is $333. The second method is the apportionment method, which you use if you didn't get a valuation. Instead of valuing the asset, you just split the whole gain by time. You held it for 4 years, 3 of those years before the cutoff, and 1 of the years after the cutoff. So 3/4 of the gain goes under the discount and 1/4 under indexation. Run that and the capital gain comes out at $750. So the tax is closer to $353. You choose whichever method gives you the lower number when you lodge your tax return, which is why in practice you'd work out both. And which one wins just depends on when the growth happened. In the example, most of the gain was before the cutoff. So the valuation method and the 50% discount won. But flip it around, say the $300 of growth was before 1 July 2027, and then the rest of the gain was after. And now the bulk of your gain is stuck under the new indexation rules. The taxable gain will be different and it's going to be less if you use the apportionment method. Here's why that matters most for where you hold things. In a company, you don't do any of this. You just pay the company tax rate on the gain, 25% or 30% with no splitting and no method to choose. And for any asset you buy from here on, almost all of its growth is going to fall after the cutoff under the new rules. So on the top tax rate, personally, you'd end up paying more than the company would. That's the same conclusion I reached before the budget, except now the maths makes it even harder to argue with. That holds for any asset, but the place it really lands is the one that you've spent your whole life building, which is your business. When you sell it, the gain on the goodwill or on the shares, if you sell the shares, gets taxed at a minimum of 32% with no discount. On a sale worth a few $100,000 in gain or a few million, that's a meaningfully bigger tax bill than it would have been 2 years ago. But there's one thing the budget left completely alone, and it's the most important tool you've got. The small business capital gains tax concessions were not touched. All 4 of them survived. And depending on which ones you qualify for, they can knock your tax on a business sale down significantly. In some cases, all the way down to 0. Let me show you how powerful that is. Take a business owner selling with a $4 million capital gain. Stack the concessions they qualify for, the active asset reduction, then the retirement exemption, and a gain of that size can come down to little or even no tax at all. Losing the old 50% general discount does leave a slice more exposed than it used to be, maybe a few $100,000 of tax, where there might have been none before. But even then, you're talking about an effective tax rate of around 12% on a $4 million gain, which is a world away from the 32% minimum you'd pay without the concessions. So even though the rate went up, the number that really decides your tax bill on the sale is whether you qualify for those concessions, because qualifying is worth far more to you than the old 50% discount ever was. And that's exactly where a lot of business owners are about to get caught out. There's a catch with those concessions though. To access them, you have to come in under certain thresholds. You must have either net assets of under 6 million or turnover of under 2 million. Sounds reasonable until you realize those numbers were set in 2007 and they haven't moved since. 18 years, no indexation, while every business around them grew. If those thresholds had have just kept pace with inflation, they'd be sitting somewhere around 10 million in net assets and 3.3 million in turnover today. So there's a whole band of business owners who are too big for the concessions purely because the goalposts never moved, not because they were actually large businesses. And the numbers back this up. More than 90% of businesses still turn over less than 2 million. So most do squeak under the line. But the fastest growing group is the ones between 5 and 10 million in turnover, which is exactly the band these frozen thresholds punish. And in plenty of industries, 2 million of revenue is barely one decent job. A builder doing a couple of houses looks nothing like a software business on the same revenue, but the turnover test treats them the same. Picture 2 service-based businesses side by side. One is turning over 1.8 million, comes in under the threshold, and the sale can be used to apply the concessions to wipe out most or all of the tax. The other one's at 2.4 million, just over, and gets none of it. So the full gain is taxed at the minimum 32%. Same kind of business, similar sale price, wildly different tax bills. And the only thing separating them is a threshold frozen in 2007. A lot of you watching right now are in that band or growing into it. So whether you cross that line before you sell is now one of the biggest numbers in your entire exit. Now, not all is lost. You may still be able to access the concessions using what's known as the $6 million net asset test. Under this test, you can still access the concessions if your turnover is over $2 million, but your net assets, excluding your family home and superannuation, are under $6 million. If you don't satisfy either the $2 million turnover test or the $6 million net asset test, something else has just been announced by the government, and this announcement could end up saving you millions of tax when you sell. The Labor Party have been under so much pressure with the CGT changes that they have provided just one of the small business CGT concessions to businesses turning over less than 10 million. We don't know all the details yet, but what has been proposed is that if you are turning over less than 10 million, you gain access to the active asset reduction, which is a 50% discount on the gain. That means for a $4 million gain, you're now paying tax on $2 million. And there's a second number that is just as easy to miss because of how the new rules are timed. That second number comes from the date the rules start, and it's going to hit almost everyone who owns a business. The way the legislation does it is a bit clever. Every asset you're holding on 30 June 2027 is treated as if you sold it that day and then bought it back the next morning on 1 July. You don't actually pay anything at that point because it just creates a deferred gain or loss that sits there and only crystallizes when you eventually sell the asset down the track. The whole purpose is to draw a line in the sand so any growth before 1 July 2027 is dealt with under the old rules, and anything after it falls under the indexation and the new 32% minimum, with that 1 July value becoming your new cost base. So when you eventually sell, you've got two ways to work out that pre-cutoff portion. You can get a proper valuation of the asset done at that date, which fixes the gain precisely and then lets indexation run on everything after it. Or you can use an apportionment method that the government will set out in its own rules, which is more of a formula than a valuation. You make the choice when you lodge your tax return for the year you actually sell, so you're not locked in on day one. Here's where it gets real for business owners. For listed shares, there is a market price, so the valuation is easy. But a privately held business has no published price. So if you want the valuation method rather than the formula, someone has to actually value the business at 30 June 2027. And the same goes for any property that isn't straightforward to price. That's potentially a valuation on nearly every private business and property in the country tied to a single date. And right now, nobody is planning for it. And it isn't free. A valuation on a clean operating business with tidy accounts starts from somewhere between 5 and 10 grand. And the more entities, trusts, and moving parts you've got, the higher it climbs. A residential property is cheaper, a few $100s, but a commercial property or a complex one runs higher again. So this is a genuine cost landing on a lot of people at once. And the time to think about it is well before that 2027 date, not in a panic afterwards. So what does this actually mean for you in practice? Timing still matters, even with the 32% flaw. If you can line up a sale for a year when you've got little or no other income. Maybe you've stepped back or taken a year off, or you're easing into retirement. You keep the game from stacking on top of a salary and pushing you into the top tax bracket. You can't get anywhere below 30% anymore, but there's still a real difference between paying the minimum and paying the top tax rate. A company structure helps here too, because you can control when the gains are released to you by dividends. There's no forced distribution the way a trust pushes income out every year. So you decide timing rather than the calendar year deciding it for you. And if you qualify for these small business concessions, that's still the biggest single lever that you can use on a business sale. So it's worth knowing well ahead of time whether you're under those thresholds or whether there's anything that you can do about it before you sell. For surplus profits you're investing along the way, a company is now the obvious obvious home for them, which is the case I made earlier with the maths. If you're thinking of selling your business in the next few years, or you're sitting on investments in your own name with big unrealized gains, the structure you're in and the timing of the sale matter more now than they ever have. If you want my team to look at your situation and work through the best way through it, there's a link to book a call below.